Good morning, everybody, and welcome to a conversation about the new reality for financial markets. What's so perfect about this panel is that our panelists come to the conversation from three distinct perspectives. Jenny Johnson, here to my left, is the CEO of Franklin Templeton, speaks for asset management, $1.4 trillion to be precise. His Excellency, Ghanem Al Ghenaiman, Managing Director of the Kuwait Investment Authority, speaks for sovereign wealth. And Tidjane Thiam, the Executive Chairman of Freedom Acquisition, speaks for SPACs, but also, of course, for banking and private wealth as the former CEO of Credit Suisse. Ladies and gentlemen, you've been told about scanning the QR code to submit questions. I have an iPad here, and I will be looking for them and doing my best to weave them into this question and answer session. Now, for my panelists. You all run businesses that depend to varying degrees on capital flows. You've all survived bear markets, and you've all felt the sting of a recession. So I want you to help us make sense of the current situation. That's where we're going to begin. And Tidjane, in fact, we're going to begin with you. You've seen a lot over the course of your career. Does it feel to you right now that we've been to the bottom of the sell-off in stocks and credit and risk assets in general, or is there more to come?
Erik, thank you for this slightly challenging question, but I will answer. I would say no. I think if you look at the big headlines and what's going on in the global economy, you've had a series of supply shocks. Starting with the impact of COVID on the supply chains, what we've seen recently in the Ukraine, which have been challenging for the economy. Then you have, of course, inflation. I'm sure we'll talk about it a lot on this panel. Possibly significantly caused by some of the reactions to the COVID challenge and the scale of the stimulus put in the economy. Anecdotally, I'm on the board of Kering, which owns luxury brands like Gucci and Yves Saint Laurent, and we certainly have seen some of the COVID money being spent in our shops and stores across geographies, particularly in the US. So there is a real link there. And I think for emerging markets, the ones that are not oil producing, there is a quite toxic policy mix to achieve, because if they don't raise interest rates fast enough, their currency is going to weaken, which makes all the problems around imports, etc., more difficult. The trade balance becomes more negative. Now, if they react to protect their currency against the major currencies, then they also risk choking the domestic economy in situation where there is a lot of poverty. So that's also a factor of instability. And then there is China. I don't want to take too long, but there is also the question of China and how China is going to evolve in its effort to contain COVID. So a lot of big themes out there: supply chain shocks, the impact of COVID, short-term and long-term, China, inflation, and how the central banks are going to handle all that. So on balance, I think we have not reached the bottom, and there'll be opportunities for markets to go lower, which for me, as a buyer of company, is interesting. I actually think there'll be a lot of opportunities to invest as there's dislocation in those markets as a result of those forces.
That is quite the comprehensive macroeconomic analysis. Your Excellency, share with us your perspective on some of the things that Tidjane touched on and how you are processing these inputs, if you will, as an investor.
Right, thank you very much. Thank you for having me, Erik, and I'm glad to be part of this panel. Actually, I totally agree that the market has gone through a lot of challenges nowadays, and we, as an investors, we really trying to find where the opportunity is now in this market, whether the market in the developed market or in the emerging market. So the opportunity definitely is going to be around. You look at the market usually when it's going to the performing very well, then we said, okay, this is a chance either to take some money out of the table and raise the cash and waiting for those opportunities to rise, and then we invest in it. Or sometimes we can just ride the market as long as it takes, and then prepare ourselves to be ready when the market is down, like what's happening these days. I believe that the market will go down further from here, but it's not going to be significant downside from this level. All the central banks, in the world is really concerning about the interest rate, how much they raise the interest rate to catch the inflation. But this is a very difficult game, I guess, because you have to be very aggressive in raising rate to level or to balance the inflation. However, the Kuwait Investment Authority is dealing with a lot of the big main assets managers around the world. Templeton is one of those managers that we are really giving them a lot of money to invest and to tell us exactly where the opportunity is. Where we're not talking about just the public market, we're also talking about the private market, where we see a lot of opportunities as well. Looking to the infrastructure sector or looking into the private equity, even the real estate is part of where the opportunity would rise, when the market it come to a downside market.
So you share the view that we still have a little ways to go before we're. How do you know when to dynamically reinvest? You talked about taking money off the table and waiting for that moment when prices are low enough to entice you back in. How do you know when we're there?
Well, that's something that we make our sense. We don't have a crystal ball and we look at it, but the valuation is our main index that we look at. When we see the valuation is rising and keep rising and keep rising, definitely there will be some time that the valuation will stop and come down. If you look at the S&P, it's reached to 2021 PE and now it's down to 16 or so. Then that's mean the market is ready to give more of what's being given in the good market, the good time. So, and that's one of the major things. Plus, we have our system that we feed up with all the information, and we run a distressed, scenarios where the market is going, and we start doing that when see the inflation is high, and we've done that also when the war started back in February, and we see the market is really giving us an indication is going down. So we take more money, not just to take more money, not to invest, not to deploy all the cash that we are been raising for a while, just waiting for the good time, which we believe is before the end of this year, we will be, open our cash and start to invest it in many opportunities. That's where the time, I guess, all of our, as we are in the sovereign wealth funds, waiting for, just waiting for things to come down, then we get to invest money for longer term, which was happening with all the crises that we went through all those years back in those years. The last one is the pandemic. We made a lot of money after that, the pandemic is over now.
Jenny, I know you well enough to know the last thing you would consider yourself to be is a macroeconomic forecaster. But scenario modeling...
It never stops me from having opinions.
That's why she's here, everybody. Scenario modeling, of course, is a critical part of business planning. Mm-hmm. So what are you baking into the future?
Well, I think, one of the things that, and both these guys talked about it, is the supply shocks. So, you have 80% of central banks out there that are increasing rates. So we know inflation's pretty rampant. That is a demand. That's a tool for demand. But when it comes to the war, when it comes to China's zero COVID policy, so you're locking down supply there. Honestly, climate change and extreme weather, we already saw before the war that you had food issues, and then deglobalization, where people want to change they want to diversify their supply chain, which probably results in increased costs. What that means, because none of us knows when any of these things are going to end, is there's going to be a lot more volatility. And so I would say it gets you back to the fundamental asset allocation, active management, because I think you want to be selective. And you ask Ghanem, Your Excellency here, about when he deploys. Well, there's the old saying is bears make money, bulls make money, pigs get slaughtered, right? You can't wait always for the bottom. So you start to deploy, appropriately, and you look for the opportunities. I think in emerging markets, there's clearly going to be countries that are winners in supply chain. You hear about Apple opening up in Vietnam. I think things like private credit that's tied to floating. You get those companies that are good cash flowing companies. It's going to be an opportunity. But I think in the end, if you look at those supply risks, I'm not sure we would have called all of those, and that's why having that diversified good asset allocation, I think, matters, and it's why there's discipline in investment process.
Jenny, over the last decade, as central banks slash rates to zero or even less than zero, and of course pump the financial system full of liquidity, more than $4 trillion, much of it in search of yield, flowed into private markets. And now, of course, the reverse is happening, right? Rates are rising, liquidity is being drained in the fight against inflation. What happens to this love affair with privates and alternatives?
So I don't think that the allocation of private markets was just people looking for yield. That was definitely a factor. But the reality is, I keep literally this chart on my phone. In 2000, bit of anomaly time, companies were going public after 3 years. Now companies are waiting 9 or 10 years to go public. This is U.S. companies. There's half the number of U.S. equities than there were in 2000. There's 5 times the number of private equity-backed firms. So that growth that happened between year 3 and year 10 is now just captured in the private markets. Private credit, you talk to bankers, they're keeping their capital for their best customers. So they don't necessarily want to lend in the way they lended in the past, and so that's created this opportunity for private credit. So I just don't think this trend, I think there's a lot of factors that have pushed folks into private markets. I don't think that changes. I actually think the focus has to be on the democratization of private markets so that you can capture what used to be IPOs in mutual funds are now only captured in the private equity firm and the venture capital firms. So how do you bring that responsibility to really the masses? And that's I think the challenge. I don't think you reverse back.
Your Excellency, these changes in conditions that I just described, how are you responding to that? Let me put it that way. Does your appetite for private assets, I assume that KIA has been an aggressive investor in private assets, just like many sovereigns over the past decade. Does that change your appetite for privates? Do you refocus your attention on the discounts available in public markets?
Right. Well, KIA consider one of the big sovereign wealth fund believes in private, long time ago. And the private is one of the big assets allocation we have. It's over 10%, of our portfolio in private equity only. I'm not talking about infrastructures or real estate. That's beside that.
Just private equity.
Just private
10%.
equity, and we have as much as 400 different private equity managers around the world, covering all sectors, everything. And that's really rewarding, in a good time and in a bad time, because, when in a good time, they've just been selling and making a lot of, multiples, in what they are selling. And in the bad time, which is, going through, if the valuation is good, then they really buying those assets and selling it after 3-5 years from now. So private is really a market that we are consider focusing now more into the infrastructure project in general. You know, not just the U.S. The U.S. will offer also good opportunities in infrastructures, but again, Europe, Asia as well. Well, there is I think all the time you need to do more projects in infrastructure because some transportations, whether it is energy or so you need to do more roads, open more airports. Sometimes you need to build more utilities, to power, for those living. So yes, we are investing. We'll continue investing. We will be, buying in a big tickets in the private equity.
So, just so that I understand and everyone else understands, the change in conditions doesn't in any way reduce your appetite for
Does not.
Private assets.
Does not.
Tidjane, if this environment persists, what happens to capital flows? We know, of course, that the 60-40 portfolio is broken, doesn't work any longer. Bonds don't cushion equities the way that they used to. That being the case, it seems like there's nowhere to hide. Where does the money go?
I think there's several things that have been said by my co-panelists. One comment on private markets. I raised the SPAC, so we've been looking for a target. I think we announced yesterday a transaction with a California-based company in the healthcare sector, but we saw 75 companies in great detail. And having been a CEO for 11 years, very large companies, for me it was very refreshing. And I think it's not possible to overstate the level of transformation that is going on across geographies and across sectors. I've particularly looked at 3 sectors. It was really financial services, healthcare, and a bit of media entertainment. And there is a degree of innovation, real innovation, driven by technology. But you can see across Asia, across Latin America, across Africa today, there's $5 billion of private equity money that went into Africa just last year. That is unprecedented. So I think a lot of capital is looking at those opportunities. I was struck. I called an investor whom I know well in California because I wanted to talk to him about an opportunity. And he said, oh, by the way, since I have you, I actually have 15 investments in Africa right now. And I was shocked because he's somebody who was in Facebook. He was the first private investor in Facebook. And he wanted to talk suddenly about Ghana and Nigeria and South Africa. And that's really new. You have throwing around some numbers. 30 years ago, GDP was $600 million, more or less. It's now 2.3 trillion. In Africa, the size of India, and growing at 6 or 7%. So plenty of opportunities. I think the capital will flow to those opportunities. I think a lot of those opportunities are designed for long-term investors, patient capital, who are really looking like generating returns over the long term. And the other thing I'll say about markets is really don't underestimate the will of central banks to deal with this inflation issue. Central banks do not look at inflation, they look at the anchoring of inflation expectations. Okay, that's the only thing that matters to them. If you talk to Mario Draghi, he was at the ECB, and these are getting higher. And one of the only ways the central bank can handle that is by surprising and really shocking us into accepting that the inflation will not be allowed to continue. So I think one prediction I can make with confidence is that there will be, again, more surprises and more shocks coming from central banks because they want to achieve that outcome. They need to in order to take the inflation expectations back down, which is the only thing that will ultimately beat inflation. So that, I think when you think about your portfolio and asset allocation, one should think that shocks in the fixed income market are quite likely with kind of ripple effect in the equity market. So lots of volatility, lots of changes in multiples, but I think also buying opportunities, as I said earlier.
Tidjane, since you raised SPACs, I want to ask you a question about them. And for those who don't know what he was referring to, Tidjane's company, Freedom Acquisition, is a special purpose acquisition company, and just yesterday announced that it had found a target for the $345 million that it raised back in February of 21, a company called Human Longevity.
Right.
Tidjane, you found a target, but many SPACs haven't, and time is running out. Is there a future for SPACs, especially under the tighter rules proposed by the U.S. Securities and Exchange Commission?
Well, there will always be a future for SPACs. I think they plug a gap in the market. They're well designed for a certain type of companies, and they present some advantages over an IPO. I mean, the process tends to be faster with fewer doubts, etc. Now, it's the nature of financial innovation that every time a new financial instrument appears, there is overshooting, okay? And things will sort themselves out. So what we found is that the SPACs that are created for the right reason, i.e. with a thesis, our thesis was really to focus on sectors that are ripe for disruption through technology. Okay? And we had healthcare, we had financial services, and we've delivered on that are promoted by credible sponsors, people with a track record of delivery, and have not been created for just opportunistic reasons. You find that we had no difficulty. I said we spoke to 75 companies. We had no difficulty talking to targets. And the last thing I will say is that you have to be disciplined. So we are only announcing a deal now 15 months into our life, because I can tell you we passed up many opportunities, one of which is now trading at $1.5 from $10. So every time people told me, well, why haven't you done a deal? I would say, well, because I'm disciplined. So if you have a thesis, if you have the capabilities, and if you're disciplined, I think this is a viable proposition. But of course, there's been a bit of a kind of over-enthusiasm last year, and it's not clear that all of those SPACs will find a target.
Even before the pandemic, the hottest trend in investing was sustainability. ESG assets under management are on track to surpass $50 trillion by 2025. But of course, measuring sustainability was always problematic, and now regulators are cracking down. What they don't like, and what no one really wants, is greenwashing. Your Excellency, the KIA describes itself as a force for good in global markets. Do you believe in sustainable investing?
Yes, we do believe in sustainable investments, and we also believe in the ESG in general. And we, as a KIA, founder of two big initiatives, which is One World, One Planet, and also SMI, which is Sustainable Market Initiatives. And we've been watching the growing of those task force, in those initiatives. And we are trying to be attending all those events and support them, and ask all our portfolio managers to comply with those ESG as much as they can now.
How do you know that what you're being sold is truly sustainable?
We just look into the, there is some agencies rating those companies, so if they rated it as complied or semi-complied, or they are in the process to be complied, then we will, believe in those the agencies telling us exactly we are heading into a good or perfect compliant with all those regulators. But we really, encourage all our investors managers to, we voluntarily ask them. We're not, asking them to do it. But I think with time we will be going to put that into our agreement that all their investment should be in compliance with the ESG obligations.
Jenny, you're committed to integrating ESG into investments. Will the backlash against sustainability, some of it politically driven, you know exactly what I'm talking about, change your approach?
No, look, in the case of ESG, you can't let perfect be the enemy of good. Like, we're all on a journey. I mean, the 5 agencies in the U.S. or the 5 data providers in the U.S. only correlate 54% of the time. So, it's not perfect. I also think we've seen with the war in Russia and Ukraine that you suddenly heard about people who said no weapons at all are now talking about weapons for peace. I think the realization that, oh, by the way, when you divest of, say, an Exxon, that doesn't mean you've actually improved any renewable energy. You need the balance sheets, you need the commitment of those who, Kuwait and, various countries that are earning money from fossil fuels to use that balance sheet to invest. So I think this is a process that's continuing to evolve because as the data gets better, what the regulators are coming after in the U.S., they want to know that whatever you said you're selling, that you're doing, so prove it to me in your paperwork.
Too.
Yeah, and Europe is whatever impact you're saying you're making on society, prove to me that you measure that. So one's investment process, the other's impact. And I don't think that goes away. I think this is a natural evolution.
Folks, when times are gloomy, it's always nice to conclude on an optimistic note. So my final question to my panelists is this. And panelists, we're going to have to make it a quick one because we're running out of time and I don't want to hold things up. I want you to think long term. I want you to cast your eyes into the future. Jenny, beginning with you, what's the next big thing in finance and investing?
So, look, I am a huge fan of blockchain, and what drives me absolutely bonkers is every conversation about blockchain ends up in a conversation about cryptocurrencies and Bitcoin. I wish people would treat them like two different categories. Cryptocurrencies are like a religion. There's no fundamental, you can believe or disagree, whatever. The blockchain and the disruption in the businesses that are being created by this technology is very, very real. And what this bear market in digital assets is doing is what old Warren Buffett said, when the tide goes out, you'll see who's swimming naked. That the reality is the good companies, the next big good companies are going to come out of this space, the next Amazons, Googles, others, and there's going to be a lot more that will get washed away.
Tidjane, next big thing in finance and investing.
Healthcare. Health expenditures are choking the large economies. If you have something that grows faster than your wealth, it's going to choke you. And technology gives us the means to actually handle that. Like this company we're buying, if you look at your lifetime healthcare expenditure, it's a lot of money, but half of it is spent in your last 6 months. So the impact of prevention in terms of preventing the stage 3, stage 4 illnesses that cost so much will be crucial. It hasn't happened yet. Most sectors have been disrupted by technology. We're kind of sitting duck, and a big opportunity is healthcare. And some have failed, a lot of people are trying, but it's going to happen anyway. The technology is there, and it's a global opportunity.
Your Excellency.
Well, energy and IT. Those two sectors that we are really reviewing a lot of the opportunities now. We've been meeting with many of asset managers and also officials, from government. They gotta open their book for us to invest, in a big way into our money. And I think one of the statement for this session is uncertainty is the name of the game. And I think we as sovereign wealth funds, I think including Fahad here, we love this game actually. So we want to be deploying a lot of money, and we're looking forward to invest in those two big sectors.
Your Excellency, Jenny Thiam, a terrific conversation. I knew it would be. Ladies and gentlemen, please join me in thanking our panelists.